Good morning, and thanks for joining Tecnoglass for our second Q results. We're going to start with the highlights for the quarter, which was a record quarter in terms of revenues, growing significantly 15% to $295 million, which was a record, with both segments contributing equally. Single family residential up 15.5% to 126 million. Commercial construction growing 15.7% to 169 million. Both were record level quarters. So the order level and the demand trends continue to be really strong. We'll go into more of that in a minute. Commensurate to that, our record backlog continues to grow. We're now at almost 1.4 billion, up almost 10% year on year. This is coming from market share gains, geographical expansion, and obviously the new product introductions that we have discussed in quarters past. Very strong geographical diversification. That being said, project profits and margins year on year were impacted by the same impacts that we had last quarter, mainly stronger currency, much higher aluminum costs, and now newly put in place tariffs that came about in Q2 of this year versus last year, which we had already discussed in last quarter. Moving on into the second quarter backlog, we grew 10% as we had discussed to a record of almost 1.4 billion, much more diversified as we continue to do this geographical expansion that we have undertaken in the last couple of years. The conversion of the backlog continues to be in line as in the last couple of quarters. Essentially, more projects that are high end and take about 24 months in execution. So what you see from a backlog conversion is that this backlog is going to take us out into 2028 now, roughly 24 months of execution, which provides very strong visibility. On the single family residential side, as I was mentioning, at an all-time high of 126 million, orders were up 8% year on year and about 35% sequentially Q1 versus Q2, which was a really nice trend. As we had discussed previously, we did price increases in May, so we also have to account for a pull forward effect that we estimate to be about $15 million more or less on the single family residential side of orders that were placed ahead of the price increase taking place at the beginning of May. We have clearly outperformed the market. We continue to gain market share. Obviously, the single family residential space is not performing at this pace or growing 15% year over year, but we were very pleased with the continued market penetration, our ability to gain market share in other geographies in our core markets, in our ability to continue leveraging our competitive advantages in a challenging period, which obviously we're going to discuss here in a little bit as to what are the challenges that we're seeing, nothing different than what we had seen at the beginning of the year. From a revenue bridge perspective, I think we already discussed this, up 15% year on year, continued backlog, which continues to give us very good visibility on the commercial segment and obviously strong execution there. Orders are up. I think obviously not only our core market continues to perform well, better secular trends in the Southeast than the remaining of the US, but also expanding into new geographies. From an EBITDA bridge perspective, different story. Obviously, sales growth is helping, is providing operating leverage. But at the same time, we continue to see challenges and headwinds in terms of raw material cost. As we had discussed, aluminum is up over 50% year on year for the reasons that we all know. Higher interest cost is driving inflation, the war in Iran, the tariffs that were put in place are also creating some different dynamics. So aluminum costs have skyrocketed with U.S. aluminum premiums almost at an all-time high. In our case in particular, we have had a very strong currency revaluation. The peso has gotten stronger at a pace of about 15% year on year, which is impacting our costs that are denominated in the Colombian peso, which, as we had discussed in the past, equates to about roughly 20 to 25% of the overall cost and expense total for the company. Additionally, as we announced about a couple of months ago, 2-3 months ago, the U.S. government put in place newly established Section 232 aluminum tariffs, which we had kind of talked about in our previous call, that impact the exports that we put in place from Colombia to the U.S. at about 10% for each window that gets exported. So obviously, this impact, which was about 18 million in the quarter year on year, had a negative impact on a comparable basis. We see some of these as temporary effects, and we put in place pricing adjustments in May that start flowing through the P&L in July of this year for the single-family residential segment. 7% price increases on their single-family residential products are going to start helping us in the second half of the year. Also, we have been investing significantly in automation, as we have discussed before. So obviously, that's going to help us generate efficiencies, headcount reductions. We're doing some improvements on the logistics side of things. So we foresee the second quarter obviously being more challenging because we didn't have the benefits of these initiatives that I just mentioned, but we should start having some of these efficiencies flowing through the P&L in 2026, with a full offset in 2027 as far as the tariffs go. Moving on, from a balance sheet perspective, the balance sheet of the company continues to be in very strong shape, about 300 million of liquidity with leverage of about 0.6 times net debt to adjusted EBITDA. So a lot of flexibility to continue reinvesting in the business. As we had mentioned, we invested about $52 million of CapEx year to date. Mostly of that will be in automation, which will give us more efficiencies, especially starting at the end of this year and full 2027. We have reinvested, a lot of money in dividends, in buybacks. Obviously, most of what we have invested in the last 3-4 years is in discretionary growth CapEx to address growth. As you know, we have been growing at a CAGR north of 15% over the last few years. So obviously, we're investing in the business and are generating a much higher return on invested capital rather than other initiatives that we could potentially pursue. So we're well positioned to grow. We should have installed capacity north of 1.4 billion by year end. So we should be good to go to grow well beyond where we're projecting to finish the year 2026. Speaking of that, we're adjusting our guidance. We are increasing our top line, going from 1.06 billion to 1.08 billion. Now we're going up to 1.13 billion of revenues on the high end, but increasing, as I just mentioned, the low end at 1.08 billion. And that is obviously very healthy growth year on year, north of 12% versus 2025. We are adjusting our adjusted EBITDA guidance range slightly to account for stronger currency, what we're seeing as far as aluminum prices, and what had already been embedded in terms of the tariffs that were put in place by the government earlier in the year. So obviously, we'll remain vigilant as to how the rest of the year shapes up, but we continue to expect significant growth, double-digit growth, as we move, at least from a top-line perspective. With that, I'll leave you, and thank you for joining Tecnoglass for Q2, and hope to see you for our Q3 results. Thank you.